Hey, this is Chris with Suarez Home and Finance. So today I'm going to, I am recording a video on construction VA. So VA construction loans. So VA construction loan is, it is building a brand new house using a VA loan. And so it is where that we do a one-time closing and the builder gets paid draws throughout the build. And then with VA, you do not start your first payment until about 30 to 45 days after the house is complete. So for numbers, this is just how the numbers work. Hopefully we can see everything here. I've kind of zoomed in. So let's say, for instance, you're building a house. The builder's base price of the home is $300,000. So if the base price of the home is $300,000, that is you going in, sitting down and saying, this is what I want. I want this model. I want this bathroom. I want this changed, whatever. So your base price is $300,000. Then what happens is, because VA does not allow the vets to pay the interest on those draws that the builder does through the process, it is included in the build price, for lack of better words. And so let's say, for instance, at closing, you buy land. So you pick a piece of land that is, so the base price of the home is $300,000. You buy a piece of land for $50,000, you're at $350,000. Okay? So if you're at $350,000 for your build, that doesn't include any of the closing costs, nothing else. So this is your base. The $300,000, what we do is we take this. And so with VA, you have 0% down. So there's that. So you have 0% down. Okay. You have no mortgage insurance or anything like that. No mortgage insurance like FHA or USDA has a guarantee fee. So no mortgage insurance. And then also we try to have the closing costs rolled in. So if you're buying a house that's already existing, you have closing costs. So you have three things with construction. You have, number one, you have the interest on the draws. Number two, you have the construction closing cost. And then number three, you have your normal closing cost. Okay? And then, so what happens is we try to add all of this number into this total number down here, so that you're coming to the table with no money. The key on this is that the appraised value has to come in at, so if this amount is $30,000, for instance, then the appraisal has to come in at $380 for this to happen, for us to have zero down payment, which is a given anyways, but zero money to the table. You will have an escrow deposit on this builder contract, and you will have an escrow deposit normally on the land contract too. That will be removed from your bottom line for your actual loan. So if your escrow deposits totaled $5,000, then this is what your value needs to be. But your loan is going to be based on the $380. If all of this is accurate, $380 minus $5,000. So your loan is going to be based on $375,000. If the value comes in at the $380, I can actually get you back this $5,000 as long as I show it coming out of your bank account, as long as it is what's called sourced, quote unquote. You didn't put cash in the bank to do it. You didn't pay for it cash. I can see it in your bank account that it was your money. So that's how that works. So this is our big deals, okay, the interest and so on and so forth. So VA does not have the borrower pay, the service-related person pay the interest-only draws. So what happens is at closing, we do a one-time close. This is paid off at closing, the land. This is purchased, and so you are now the owner of the land. So that means that that money has already been put forward. So the draws, the interest only, the interest is accruing on this $50,000 at closing. So let's say, for instance, Your builder gives me an invoice or the receipt or whatever from the county saying how much impact fees are, how much it's going to be for your septic permit, how much is it going to be for your permits. If they have an outside engineer, how much is that? It cannot be an engineer that's in-house that the builder owns. So if I have those different things, then I can get that builder the money at closing, because they do not get a draw at closing, but they can get those hard costs at closing as long as I show something in paper in writing what those costs either are or will be, whether they paid it or not. So I can get them that money back at closing. So your interest at closing, so if we get, if $10,000 is your permits, your impact fees, which I know that that's low, but your impact fees, etc. So at closing, we've got 50,000 plus 10. This is what is starting to accrue interest on. So let's say, for instance, at the 30, 45 day mark, the interest is going to need to be paid on this money. Okay, so that is your first amount of money. Then, so this is your first payment, so to speak, on the interest only. Then, say in 60 days, your builder, so we're at the 60-day mark after closing, your builder requests to draw for 100,000. So whenever they request to draw for 100,000, your balance now on the draws is 160, and this is what is going to be, say for instance, your second payment on the interest only. Again, VA requires the builder to cover that, but this is how it works. So the builder has to have this money. So we have the base price of the home. The interest on the draws may be, say, 15,000, something like that. It depends on how long the builder is going to take to build, so on and so forth. We always have to start out at 9 months. If it goes over the 9 months, the builder has to pay that interest. The builder, it's got to be there somewhere, whatever. The builder has to have that interest payment for even after the 9 months. So we have to do 9 months, but depending on the county, the permitting is taking a long time. So if you own the land already, you're at a benefit because we kind of try to wait until the permits are back from the county in order to close. You can only do that if you own the land already. If you do not own the land, then it may say if it's 2 or 3 months for permitting to come back, the builder can't start for 2 or 3 months. So we are at a disadvantage. So again, this is where these payments are still have to be paid, but we start out at 9 months. That's what the builder is given in most cases. And then, but if it takes 12 months, there's an extra, what is that, 3 months? 3 months that he has to have interest on. So go back to the 300,000. If the interest calculated based on this 9 months, whatever, is, let's say it's 15,000. So the interest only is 15,000. Okay, and then we have construction closing cost. Construction closing cost is the inspections that have to be done. So whenever the builder calls in for a draw, the appraiser or an inspector has to go out, check to make sure everything is done up to a certain point, or what is done up to that point for the builder to get the draw. In some cases, it's a line item. So if it's so if the builder has completed lines 1 through 10 on his cost breakdown, then he'll get paid 1 through 10. If he's done 1 through 9 and number 10 is halfway done, he's going to get paid 1 through 9 and then 50% of number 10. So that's how a line item goes. Sometimes we have a percentage done, but a lot of times it's line item, which is actually a good thing, because then the builder can get those monies. So we have the interest only at 15,000. The construction closing cost, again, is the inspections that have to be done for the draws. It's the paperwork and all of this stuff that has to be done in the background, the administrative part of a construction loan. It is making sure that everybody is paid, there's nobody putting liens on your property, so on and so forth. So there's a lot to go on in the background that it is to be done. So let's say, for instance, if that number 2 is, let's say 6,000. And these are just round numbers. They don't mean anything. That's not what the numbers are based on this. It is just numbers for the example. So this is the construction closing cost. So then you have number 3, your actual closing cost, your normal closing cost, which is if you were to buy an existing home. So your normal closing costs consist of your title work, your appraisal, your survey that we need to do up front. Sometimes the builder does include the survey in here, and that's one of the questions that I ask them up front so that we know if we have to include it in your closing cost or if it's included in here, because there's different surveys that are required through the process. So the actual closing cost, again, title fees, also doc stamps on the mortgage and the deed. The deed, normally the seller pays for it, but the doc stamps on the deed would only be based on the land, so that's a good thing. It is your appraisal. It is if you have any points, if you don't, whether you have points or any kind of origination in there, which for me, points are just the origination. We don't have the underwriting and the processing. I do just points if we need it, if we have to have it, depending on what the rates are, your credit score, the whole thing. Closing costs are also, let's see, we've got appraisal, we've got title, survey, doc stamps, and then also your escrow. So we do have to collect 1 year of homeowner's insurance, even though we're not paying it, because you cannot pay for homeowner's insurance until the house is done. But we still have to collect for that 1 year of premium that we get a quote on. We have to collect for that up front. We also have to prepare for an escrow account, which pays your taxes and insurance up front. So we're taking that money, but we're holding it because those monies will not be allocated until the house is complete. And so, but it sits in an account holding for that. So we do have to collect for that. So again, you're doing VA. So we have to count against you the payment as if you are not VA exempt. So if you have any kind of VA disability, and if you're 100% VA disability, if you get that, if you're 100% exempt, then on homestead, you will pay no taxes on the ad valorem taxes. But I can't guarantee that you are going to file for homestead and that you are going to do the process to do the exemption. So I have to go based on, if you don't, this is what your taxes are. So if your property taxes, just on the estimate, that's all that we can do on new construction, is $300 a month, then I have to collect for about 5 months, depending on what time of year it is and what time we're closing and everything else. So I have to collect based on that anticipated property tax before your homestead exemption and before your VA exemption. So we're going to collect that money in escrow. That's not an option. Whenever the home is complete, you're going to file for homestead, you're going to file for the homestead exemption all in one, and then you're going to give them your VA disability letter to be 100% exempt. At that point, then you will have no non-ad valorem taxes. You will have, I said that wrong. You will not have ad valorem taxes, but you will still have non-ad valorem taxes. But that number is very, very small. So we cannot guarantee that. So in this normal closing cost, we have to collect that money. So let's say your normal closing costs are $8,000. Okay. So we have 15 plus 6 is 21 plus 8 is 29. So we have $29,000 here. So now we're going to take our 300 plus our 50, which is the 350, and then we're going to add this amount to it here. So then your purchase price becomes 350 plus 29,000, which is 379. So I'm going to go back to the builder and I'm going to say, I need a contract for 379. And this is your breakdown along with this. I'm sorry, I said that wrong. It's not the 350 because we're not buying the land from the builder. So we're buying the land from a separate seller. So our build price is 300 plus the 29, which is 329. So I'm going to say to the builder, give me 329. Here's your breakdown plus your 300. If you are buying the land from the builder, which does happen, that's where this scenario comes in. So that would be the 300 plus the land plus this number, which would be the 379. So that's how the numbers work. This again is you assuming the appraisal comes in at what we need, okay? And then also, this is with you making no payments at all until the house is complete. So if the house takes the 9 months or the 12 months, so if the house takes 1 year, for instance, in this scenario, so if the house takes 1 year, the builder is building your dream home, doing all of everything. He's getting paid on these draws, so on and so forth. You are not making a payment until 30 to 45 days normally, until the CO, which is certificate of occupancy, is issued. That means that the house is complete. The county came out, did their final inspection. The county is different from the loan, so the county has to come out and do their inspection to make sure that everything is up to code. If the CO is issued, everything is done, and then you start, and then the final payment is made to the builder. Your payment starts in 30 to 45 days. That's why all of this is in here. That's why this number is here, and it's increased. And again, you don't make a payment until 30 to 45 days after complete. Kind of doing this, I'm short, but this is kind of going downward. So 30 to 45 days after the house is complete is whenever you are going to make your first payment. So I hope this helps you. I hope you understand. Whenever we are doing a construction loan, I will not start a loan at all until we have plans, specs, we have the cost breakdown. We have to have certain things in order, which is most of it, before we can start a loan. So that means that if we don't have it, we cannot start the loan, because if we do start the loan and don't have it, it's a nightmare for you, it's a nightmare for me, and you cannot enjoy building your dream home. We want you to enjoy it. The builder and I both, we want you to enjoy this process. So we get everything up front. This is the breakdown. Any questions at all, you are to call me, call your builder. We work together. We are a team for you and with you. So again, this is Chris. Hope this makes sense to you. It's a lot. It's confusing, but this is what I do for you. So have a great day. Talk to you soon.